How does monetary policy work in a global economy? Imagine a world where what happens in one country can ripple across continents, affecting economies thousands of miles away. That's the reality of how monetary policy functions in a global economy. Central banks, which are the main authorities managing money and interest rates, aim to keep their own economies stable. They do this by adjusting how much money is available and what interest rates are. When they lower interest rates, borrowing becomes cheaper, encouraging people and businesses to spend and invest more. This can boost economic growth and employment at home. But because countries are connected through trade and finance, these changes don't stay local. When a big economy like the United States or the Eurozone changes its interest rates, it influences global interest rates. For example, if the United States raises its interest rates, it often makes U.S. assets more attractive to investors worldwide. As a result, money flows into the United States, and the dollar tends to strengthen. This makes American exports more expensive for other countries, which can slow down their economies. On the other hand, if the United States lowers its interest rates, it can stimulate global demand, making assets more appealing elsewhere and encouraging investment in emerging markets. These international effects happen through several channels. First, financial markets are linked globally. When interest rates change, asset prices like stocks and bonds react, influencing investment decisions everywhere. Second, exchange rates shift because of monetary policy. A country's currency can become stronger or weaker, affecting how competitive its goods are abroad. Third, trade flows are impacted because when demand in one country rises or falls, it influences exports and imports in other nations. Lastly, spillover effects occur when economic conditions in one country cause synchronized changes in other economies, especially during times of global instability. The size of a country, how open it is to trade and capital flows, and the strength of its financial markets all influence how much its monetary policy affects the world. Sometimes, these effects cancel each other out, but often they amplify economic ups and downs across nations. Central banks must think about these international impacts when setting policies, especially during global crises. They try to balance their domestic goals of controlling inflation and supporting jobs with the potential effects on other economies. To manage these challenges, central banks use tools like adjusting interest rates and providing liquidity to financial markets. They also monitor global financial conditions carefully. When they change interest rates, it influences how much banks keep in reserve, which affects how easily money flows through the economy. In a connected world, the decisions made in one country can spark changes for beyond its borders, making the conduct of monetary policy a careful balancing act between national needs and international consequences.